Hello, and welcome to the stock-specific class here for Thursday, February the 9th. If you have any questions during the week or any questions I don't get to here in the live class, make sure you send those to Jerry at TradersPro.com. I'll be happy to answer those for you. Also, again, a quick check on the audio. If you hear any clicking or any noises that are annoying you, make sure you let me know. I can dial back in, and that usually takes care of the problem. But again, the issue is I can't hear it on my end, so I rely on you guys to let me know if the audio is bad. I haven't had that problem though for a little while, so that's good. All right, let's get started with taking a look at the markets. We're getting a little bit of a pullback. Market tried to rattle a little bit early today. Not surprising that we are pulling back right here. Yesterday we had a bearish inside day candle we'll take a look at when we pull up the chart. So it usually means that you would expect weakness the next day out of that pattern. Like all candlestick patterns, it's not 100% accurate. It doesn't always predict a move, but it does just show you weakness. And the market's due to pull back a little bit. It got a little bit stretched on the run it made right there at the end of January, particularly at the end of January, and needs to kind of consolidate that a little bit. And we'll see that in the charts here in just a second. But as far as the direction alerts, obviously with the market pulling back a little bit, it's causing the indicators to come off of, they weren't stretched except for sentiment, but it caused them to kind of come back a little bit. What this means is that the market can continue to move in this direction or in a direction, or it could reverse trend, but it's not stretched in any way. It's not in any of these extreme ranges. Again, the biggest ones we pay attention to when we're going through this is either side of the range here. The extreme range, overbought, oversold. And so really it shouldn't take us very long to go to look at these. We just try to get a quick snapshot of whether or not the market is stretched one way or the other. Breadth, same thing, kind of in the middle, meaning it could continue to trend in either direction, but in this case, it's not suggesting that this uptrend is stretched in any way. The recent uptrend is stretched in any way. Sentiment has still remained very, very high, but it's been that way for months now, where it's been to that far side of the right side of the extreme range. So that hasn't really changed much. The buy-sell ratios have come back in a little bit. These were getting a little bit stretched, a little bit wide, but with the market pulling back, and the market looks like it could pull back a little bit further as well. There's not a lot going on news-wise. There's always earnings coming out, but we're starting to get to the winding down part of earnings season. Most of the major companies that most people were really watching and that have already reported, Amazon, Google, Meta, Apple, all those companies have reported, and then also we've had the Fed meeting. We've had, this week we've had the Fed presidents talking, and they're some of what they're saying are moving the markets a little bit, but not a whole lot going on for the next few days. We do have the CPI report coming out on Tuesday, I believe. I think it's on February the 4th, on Valentine's Day. Happy Valentine's Day. Here's the CPI report. That could be something that obviously that is what the market's focused on next. They always go from Fed right to the CPI report. Inflation is still the big driver. Now, by the way, and I've said this a number of times, the market will tend to focus on certain things at certain times, and you do want to kind of pay attention to what it's focusing on, because that can give you a little bit of a clue of how it'll react to some of the news items that come out related to those things. but it's also important you realize the market's not always going to focus on that. A good example of this was several years ago. This is going back probably a decade. There was stuff going on in Europe, and I remember every day the first thing we would do is see how the European markets were trading, how they were dealing with the problem they were dealing with, and then the U.S. markets were reacting to that. Now that's usually very rare. In fact, I haven't looked at the European markets for several months now because it hasn't really factored into anything that is going on here in the U.S. Not that they're not important to the people that live in those countries, but again, it hasn't had an effect on the U.S. markets, and so the markets just stopped focusing on that. It's moved on to something else. Right now, it's inflation, it's CPI. Fed news, and the Fed is always front and center. But I will tell you, there are many Fed meetings where there's not that big of a focus on what they're saying. It's not going to have a big reaction to the market. So the reason why it's been pretty intense lately is because of the inflation problem and how they're dealing with inflation and all that kind of stuff. But, so just be aware of that yes, we're talking CPI right now and focusing on when the next report comes out. But 6 months from now, we might not even bring it up or even pay much attention to what's going on there. We'll be focused on something else that is the driving force of the economy or of the markets. So buy-sell ratios coming in a little bit, alleviating. They weren't stretched by too much, but they were starting to get that way, and they kind of come in a little bit. Sentiment also was extreme here. Not surprising, we're getting a little bit of a market pullback after getting that extreme, but alleviated that a little bit. We'd like to see it come back down a little bit further, which it would likely do if the market pulls back a little bit more. Let's take a look at the charts. I can show you. So here's that bearish inside day from yesterday. So you have a bullish bar that's bigger. Then you have the next day, the entire bar of the next day, or candle in this case, is inside of the previous day, and it's in the opposite direction. Now, it's not just that. You want to see something like that. Context is important. You'd like to see a little bit of a run up before you get an inside day. If the market has moved down and you get this type of inside day, it actually has the opposite effect, where it actually it's not a very strong bullish signal, but it's showing selling exhaustion if that shows up at a bottom. I'm trying to see if I can see one here where it's at a bottom. It doesn't happen very often at the lows. In fact, what you'd be looking for on a downward move is you look for a bullish inside day. But anyway, that it usually tells you there's a high probability that within a day or two you should see the market pull back. A lot of times it's immediate. I've traded some of these just overnight, where the next day it drops. But it tried to open again. I think the way it behaved today is showing a lot more weakness in the near term, because it tried to open higher. It tried to rally off of that bearish inside day, and then it's faded back down to where now we are moving lower. We'd still like to see if we can move. You still want to see if you can move up below or above that initial candle from Tuesday. So if we can close below the low of or at least the open of that day, that would be a stronger near-term bearish signal as well. But I think all that's happening is this is kind of a wave A. You're getting your attempted wave B up here. Oops, B. And then we'll get a wave C that comes down here a little bit. And if that happens, that'll be good, because it'll alleviate that kind of and again, we never really got into a strong overbought condition, but it'll alleviate and kind of digest the move that we've had recently, and it'll give you a better entry point into trades. Now, something I've talked about over the last couple of classes is, what you want to see when you start to, in order to strengthen the bullish or bearish argument, what you want to pay attention to when you see a stock that's moved up, and you're wondering if this is well, let's say you've had this downward move, okay, and then you move up, you have an impulsive move up, and you're wondering, is this the bottom and you're starting a new uptrend, or is this just a rally within the downtrend and you're going to continue to move down? You're trying to figure out what that means. A lot of times what you want to pay attention to is how it pulls back. When it first starts to pull back, how does it pull back? If it starts selling off in a big way and drops very, very quickly, if we suddenly have a really big down day and we're coming down very, very sharply, then this whole move is probably just a correction within that larger trend. And we've already talked about that. Go to your chart here, being a possibility here. This could just be a bearish ABC pattern, and you head lower. It looks like you're breaking out to the bullish side, and then it comes back down. I still think that's a possibility, but I think it'll probably get up closer to here before it would roll over. If it's going to roll over, maybe it won't. But the point is that you want to see how it sells off when it starts to sell off again. Because if it sells off sharply, it means that this is probably just a rally within the downtrend. If it pulls back in kind of a choppy or sideways type of a fashion, that tells you that there's a good chance that you're still in the uptrend, because it's telling you their sellers aren't there. They're not, people aren't panic selling. They're probably just profit taking. When you ever see these downward moves that are just choppy, it's just people that are, they're cashing things in. They had this little run up right here. They made some good money on some stocks, and they're cashing out, and so it's not aggressive selling that's taking place. So we want to see how it pulls back. That can tell you a lot. So we already have a little bit of a choppy move right here, where we've seen a little bit of the dip buying taking place. Pull back a little bit. Dip buyers jumped in on Tuesday. Pull back a little bit on Wednesday. Looks like we're pulling back a little bit today. If we come back down here a little bit further, where that's kind of a wave A, wave B, wave C, then again, it sets up for another possible explosive move. So now it's important to kind of factor that in. Today, I want to go through a lot of individual stocks and look at some, and that's why it's a stock specific class, is to go over some specific stocks that look good, that are trending up. But you also want to make sure you're going in the direction of the market as much as possible. And so this near term, it's showing in the near term we should pull back a little bit further. So I wouldn't recommend jumping into these trades I'm going to go over today. Maybe wait another day or two to see if the market pulls back a little bit further. It gives you a little bit better entry point. Now, a lot of the stocks I'm looking at are usually going to have hold signals, except when I'm going off the new buy list. Those will all have new buy signals. But if they have a hold signal, you could always wait for it to go from hold to buy as your confirmation to look to get in, and kind of do it that way. But I would, it looks to me like I said, the market can pull back a little bit from here in the near term. The Dow has been showing some underperformance to the other indexes, which is understandable. The Dow is leading the way up back in here. Really strong move up from those October lows. And so what you're seeing now, I think, is you're seeing a rotation, money coming out of the industrials, and it's going into small caps and tech, into the Qs, the NASDAQ 100 stocks. Those have been on a tear. So you see the underperformance of the Dow. you go to the NASDAQ and you see the overperformance of the NASDAQ. And so that kind of makes sense that, people are cashing out of the profits they have in some of those Dow stocks. They're thinking that if they're thinking the markets are taking off again, we're in a new bull market, chances are NASDAQ, Russell 2000, those type of stocks will usually lead the way. So why not get into leadership? And so you're kind of seeing that rotation. But you look at the Qs, same thing. You got a bearish inside day yesterday. Tried to rally early today, but it faded. Probably could pull back a little bit, maybe back to this little breakout area right here. A lot of times what will happen is you'll break out. You have a correction right here. There's your breakout area right here. You'll break out of it, and then you'll come back and retest the breakout. It doesn't do this perfectly, but if you're going to be getting into chart analysis and reading chart patterns and stuff like that, that's a typical behavior. What that allows you to do is to say, okay, this looks like we broke out, looks like we're pulling back right here. Where do I think we could pull back to? Well, the most logical spot would be this area here. Just don't get focused on exactness, because sometimes it can pull back, dip a little bit below that area, and then take off. But it still pull back to the general area here. And so that's why a lot of times you'll see me call these areas zones instead of, exact areas. I'll say, well, you got a little bit of resistance right up to here. You have support right here. You have this little high right up to here and this high. So all of this could be potential support for the stock as it comes back down. And so this is kind of a support zone right into here. But that's a typical behavior where it comes back and retests the breakout area. So I always look for that when I see a stock breakout and it's pulling back again. The Russell 2000, it's down a bigger percentage today than the other indexes. And could be that it's kind of, again, it's kind of jumping into that leadership role. It's kind of leading the way up, leading the way down. Again, I'd be watching this little breakout area right here. See if it comes back down to this area. And if it does and it starts to move back up, that'd be a beautiful entry point. You get the market pulling back, alleviating some of the stretched condition. Again, not like it got very stretched, but alleviating that little bit of that stretch condition, getting ready to take off again, and that's a good point to enter at that point. All right. Bonds can't seem to make up their mind where they want to go. We talked about this on Tuesday. Kind of been consolidating into here, dropped a little bit, had a bullish reversal candle yesterday, and then a bearish candle today where it tried to open higher and it's trading lower. Overall, you could still say this is part of this corrective process, correcting this move up. If I were to say what's the higher probability direction based off of the chart, I would say that it's more likely to break out and go higher. We've been watching this high right here and this low right here. If it breaks down below that low, that'd be very bearish. If it breaks up above here, it'd be more bullish. And we're still, for now, a couple weeks, we're just stuck in this range. And so that's our outlook. But until we can break out of those areas, we won't have any confirmation of that trend direction. But again, we're leaning more towards the way it's acting right now. It's leaning more towards a bullish move or a breakout to the upside. Gold has pulled back a little bit. We talked about this on Tuesday, had the big drop here, and then it's kind of consolidated. And then today it looks like it's dropping again. Again, that it's acting like it should go lower. You get it whenever you see a stock moving sideways. You want to pay attention to the direction it's moving in before it moves sideways. That's where it's more likely to go after it's done moving sideways. It looks to be just a correction within the trend. Had a pretty big run up through here. I've got a couple gold stocks. I told you I have a pretty wide stop on those, and who knows? It could come down far enough to stop me out, but I've given it a little bit of room to correct, and I think that's, at least so far, it looks like that's what it's doing right now. Now, a lot of that can depend on what the dollar does. And I think a big part of why gold has dropped has to do with the behavior of the dollar. And we'll look at that here in just a second. But oil has been had on a little bit of a bullish run. Had a strong move up on Tuesday. Today it dropped a little bit early, but it's coming back. We're looking at right now. We're just kind of focused on this range in oil, and it's right in the middle of that range. But it's been just moving sideways here for a little while. And what I'm expecting right here is that it's going to work its way up to the upper part of that range. When it gets up here, it's probably going to work its way back down to the lower part of the range until it breaks out of this area. It's not showing us anything significant as far as direction, except for sideways. It's moving sideways right now. We're going to anticipate it'll continue to move sideways until it doesn't, until it shows us different. All right, the dollar. This is we talked about this on Tuesday, that it is this an impulsive move up? And we had this sharp move up. It's moved a little bit sideways over the next few days. Opened lower, but it's come back up. So it's got a little bit of a bullish candle today. This is acting like it wants to go higher. And now lately that's been bearish for the market. The market has tended to go down when the dollar's gone up and up when the dollar's gone down. Again, that's not always a correlation. The markets don't always move that way. There have been times when the dollar's gone up and the market's gone up, and dollar's gone down, the market's gone down. But it also does tend to have an inverse relationship for commodities, as I always say. When the dollar is strong, it tends to be weak for commodities like gold, like oil, silver, things like that. So when did gold start to sell off? Right here, when the dollar started to move up strongly. So if the dollar has another move up, I would expect gold to have another move down. Could also show or cause some weakness in oil, but oil's moved up recently with the dollar moving up. Like I said, it's not always perfectly correlated. There's a lot of different factors that move oil in particular. And so, that it's not unusual to see it not moving in opposite directions all the time. But it could be a little bit of a headwind for oil to go higher, and maybe that's why you're seeing oil open a little bit lower today. Is with maybe it is reacting a little bit to that stronger dollar. But we're still at a stage here. We don't know for sure yet if the dollar's in a trend reversal. Could it be that this just forms a bigger correction of this move, of tire move down, and then has another move down? That could happen easily as well. But all we're trying to do here is just say, hey, we're paying attention to this, because this is exactly how a lot of times how stocks come off of a bottom, is they have that first impulsive move up. They start to show a little bit more of a sideways or corrective move, and then they move up sharply again. And so you can kind of identify these early signals of potential trend reversals when they start to happen. All right. The VIX, let me flip over to, so the VIX has been moving up. Today, it's up above 20 now. We haven't been above 20 for a little while. That would probably be a little bit of more of an additional reason to be more bearish in the near term. VIX is going up. Usually VIX will go up when the market goes down. We're still low enough to where it's not showing, it's not showing that it's worried about a big move down. Usually you'll see a much bigger spike. But one thing that's been happening, this is why at this time of the day, even though we're moving at the highs of the day on the VIX, over the last several days, anytime you've had an upward day on the VIX, it's faded into the close. You can see right here, it faded from this high into the close. Here it was up to there, then faded into the close. Yesterday it was up near 20, faded into the close. Now, if it can hold the highs and close at the highs of the day today into the close, then I would be a little bit more concerned. Not necessarily that we get a big down day, but that it'd be a stronger signal that we're going to be lower tomorrow, and most likely lower tomorrow, because it's telling you those usually what's causing that VIX to fade at the end of the day is buyers are coming in at the end of the day, and if they're not showing up at the end of the day, that can tell you something. It tells you the buyers they're not there. They didn't come in at the end of the day. They're not. In this context, that would be significant, at least in the very near term. All right. So maybe we'll peek at that right at the end of the class, just to see if that's showing us anything significant. Chip stocks, again, this has been a leadership group of the NASDAQ 100. That could be a little bit of a wave A. You have this bearish inside day. Again, it tried to go higher. It's fading a little bit. Now, it's not fading the same amount as the rest of the market, as particularly NASDAQ 100. So, but you'd like to see it come back down a little bit, have that wave C. We'll see if that ends up happening. But it doesn't always have to come down. It could just move sideways within a range for a little while to consolidate. Transports have come down a little bit as well. Again, see if they're coming back to retest that breakout area. Bitcoin's coming down a little bit. All right. So again, the bottom line, and by the way, those are the reason why we go through this routine every class is that we want to get an idea of what the current market conditions are, what the current market trend is. We want to be trading with the market trend as best as we can. About 80%. You can anywhere from 70 to 80%, whatever range. Majority of stocks are going to be following the major market averages, which means that if the S&P is up for the day, there's a good chance that 80% of the stocks out there are up, that are part of the S&P 500 that are up. And so we want to try to be on the right side of that, get that extra momentum. Now, we're not always going to be right in our outlook. Obviously, trends can change, but we want to recognize either what direction we're trending in, and at times, if it looks like we're possibly changing trend direction. This can help us with a lot of decisions that we make, to get in, to get out, to move a stop, to not do any trades, to wait, be patient. All this all this information we're gathering in this analysis can help us with those decisions. I talked about some of the correlations that exist, knowing the dollar commodity relationship, knowing maybe even the dollar and the market relationship. If the dollar the market's going up when the dollar goes down, and vice versa. It may be temporary, but again, if you're seeing that behavior, you factor it into your analysis. That it can help you make a better decision. All right. So the purpose of this class, though, is to get some stocks. Bottom line with the analysis we just did, though, is a near-term weakness. We want to wait a little bit, see if the markets pull back a little bit further, and then so with these trades these stocks we're gonna go over today, you put them in a watch list or what have you, and see if you get a little bit better entry if the market does pull back a little bit further. All right, I'm going to go right to the muscle stocks tab and look at the new buys. This is a really easy process. If you're looking for a trade, you don't want to do a lot of work. These stocks they're showing you stocks that are high strength rank, that have gone from hold to buy. They've just given a buy signal, And now, again, we're not just going to go jump into it just because it's gone from hold to buy. What we want to see is do we have a nice trend there? Is there a good chart pattern there that we can consider? And so you'll notice a pretty common theme. Obviously, I like to see either a stock that has a nice uptrend that's underway, which is kind of what this one has right here. It's already been moving up. I also like to look for stocks that have come down a lot, and then they've kind of consolidated, and they look like they're coming up the right side of the bowl. Kind of get in right in this area here where it looks like you're reversing from a downtrend into an uptrend. I like the cup with handle formation where you actually finish the bowl, the cup part of the pattern, and you consolidate a little bit near the breakout area with the handle, the cup with handle pattern. You break out of these areas. Stocks can often go up about the same distance as the top of the bowl, the bottom of the bowl. So these are the types of patterns. If you're new, again, some of you have been around for a while, you know exactly what I'm looking for, but this is what these are the types of patterns I want to see. Now, the reason why I like those bowl-shaped patterns a lot better is they give me better reward to risk. I can get into a trade with a stock that looks like it's transitioning, acting like it's going into an uptrend, and I can get a stop down below here. Here's where I know I'm wrong. I don't lose very much if I'm wrong, but if it does, come all the way back up to the top here, consolidate, and break out, there's that potential for a huge reward if that pattern plays out the way I think it's playing out. On stocks that have already been in uptrends for a while, like this one, you have a higher chance of it continuing that uptrend, but you also have the risk that it could be nearing the end of the uptrend. Is it starting to get expensive? It's gone up. This stock has gone up from $8, $9 down here up to $17. It's almost doubled in value during this run. You could be that's always the risk. Once you can recognize the trend, the risk now becomes, are you near the end of the trend? Okay. But, we can still manage these and this has been going on for a while and there's no reason to believe it can't keep going, especially if this has been outperforming in a down market. And so if the market starts to improve, why can't this thing keep going higher? Okay. But one thing I like about this one here is you can kind of draw, let's go to a 1-year chart. You can draw a trend line. This won't be perfect here, but right up through here. And this is just breaking out the new high right here. Now it could pull back a little bit. The market pulls back, and you could even have it, see if it pulls back all the way to that line. You also have a little bit of support right into here, a little bit of resistance back here. In fact, you could take this. This is the lower part, the lower support right here, and it's underneath that trend line. You could put a stop down there, maybe around 14. And that's where you're wrong. If this thing came all the way down and it broke this support level, it broke this long-term uptrend support level, you'd probably want to be out of this thing. But I can manage it. I can see where I would be wrong. I like trades where I know I'm wrong. Why? Well, because that helps you stop out and take a loss when you know you're wrong. If you don't know you're wrong, where you're wrong, then every time the stock goes down, you're like, well, maybe it's going to go back up. Maybe it's going to go back up. And maybe I just, I won't have that loss if I don't sell. It's not until I sell that I have that loss. Maybe in enough, if I just wait long enough, it'll go back. And those are the stocks that usually end up going to nothing, or they just become a headache for your entire life. But it's easier to stop out, and that's why newer traders, that they struggle. They're always told you need to stop out of trades when you're wrong. The problem is they just don't know how to recognize when they're wrong. And so hopefully, some of the stuff will help teach you that you can recognize, it could just be a sell signal. Wait, if it goes to a sell signal, I'm going to stop out. But it's, when you know how to recognize it, and that's what the signals are designed for, is simplicity. Okay. Real easy. I just wait, get out when it goes to a sell signal. But I might get a clue here that I'm wrong. It may get down to 14 and not get to a sell signal yet. I might be able to get out earlier because I recognized that I was wrong earlier. And so that's the benefit of learning chart patterns and trend characteristics and things like that, is it's always going to give you an edge on someone that's just trading the signals, because it's anytime you learn something more of something, it's going to help you. It's going to benefit you. You're going to be better at it. And that's why I like the software. The software is for the people that want simplicity, and the software is for the people that want to, they want to do more work and learn more things, learn other things, and then also use the software to guide them in that. In this case, the software is telling us this is a high strength ranked stock that's just gone from hold to buy. That saved me a lot of time. Now I can apply my chart pattern skills to determine entry point, stop loss, things like that, and that's where it can be helpful. So it's down a little bit today. Like I said, I won't be surprised if it pulls back a little bit. And again, this is an oil stock. The sector has been strong, has been outperforming. Oil itself, like I said, has been sideways, but there are a lot of these oil stocks that have trended up quite nicely. That's why it's at the top of the sector list up here. Oil's been at the top of this list for months now, and eventually that'll change, because again, people made so much money in oil that when technology starts taking off, what are they going to do? They're going to say, okay, now it's time to take our profits out of the oil stocks and go into these tech stocks that are starting to take off again. If they do, computer technology is down here a little ways. But that tends to be what you see is rotation. Those professional traders will rotate out of the things that have been working and move into the areas where they think are going to work next. And by the way, you don't have to figure that out. Well, what is the next area that they're going to move into? It'll start showing up on here. You'll start seeing these sectors move up the list. You'll start seeing computer and technology move up towards the top. Usually in a bull market, computer technology stays at the top or right near the top. And consumer discretionary stocks, move up, things like that. All right. Medical stocks and biotech, that's been lagging down here for a while. There's a lot of stocks in here. This is fun when this one really starts performing, because there's so many stocks in here that you can find trade opportunities on those almost every day. And you can see consumer discretionary way down the list, which would make sense in a bear market, that these would be near the bottom. All right. Go back in. I want to look at bore drilling, BORR, 99 strength rank. Again, nice uptrend here. The drillers, they're likely to do very well over the next little while, as long as that demand for oil continues. They were hesitant to start drilling because they got burned last time. We had the big the oil boom, and they just started drilling everywhere, and then there was the bust right afterwards, and then they lost a lot of money when they had to just cut everything off. So they've been really slow to drill more. That's part of the reason why the oil prices have stayed a little bit higher is the supply side hasn't increased dramatically. But it's good because it's steady now. You're not going to see the drillers go straight up and then come straight back down. You're hoping that they should continue on this trend. By the way, this is a nice. I love these types of patterns where you can just draw the lines. I mean, connect the lows, connect the highs. And there just could be an area here where we hope that the market pulls back a little bit, have it come back down a little bit here. But if it starts touching this upper line, it could be coming back down. But it also, if you're not too worried about a perfect entry, just have a stop down below this trend line. If it ever breaks that trend line, get out. By the way, it could break out of this to the upside of that trend line too. But I like these channels because it's easy to see, and you kind of tell where you are within the trend. All right. I also like this SMCI 98 strength rank. This is in the computer and technology sector, and so you got kind of the same thing here. You had a little bit of a larger correction right through here, but again, this is the trend behavior, the basics, the fundamentals. Look at how the stock has been moving. You have an impulsive move up, meaning when I say impulsive, it means it's moving sharply in a direction. It can be up or down, but it's like boom, 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 boom. Not a lot of back and forth. And then how did it pull back? More choppy, more sideways. Not completely sideways here, but more choppy as it's pulled back. Then you got impulsive up right here, and then how is it pulled back? More choppy. Pulled back to the previous breakout area. Here's where it broke out, came back to the breakout area. Now you're seeing impulsive. Again, not all stocks behave that way perfectly, but many of them do. And so if you can learn to recognize that behavior, it gives you a little bit of an edge. So anyway, this is kind of coming off the highs of the day down here. Could pull back a little bit if the market pulls back. But this is a nice pattern here. And again, you can put a stop down below here. You're wrong. You don't lose very much. Go back to that 1 year chart. There again, you've got the channel moving right there. And this could still have room to run to get to the upper part of that channel. It's not on my chart anymore, but I do like that pattern. Rambus RMBS 97 strength rank. Again, we're just still in the new buy list under the muscle stocks. This has had a strong move. Again, I'd like to see it. There's a little bit of a consolidation into here, but chances are if the market pulls back a little bit further, this will pull back a little bit. I wouldn't mind it pulling back a little bit back down to this area here. That'd be a better entry point. But that's why the main exercise today is just give you some stocks you can kind of put in the watch list and keep an eye on. But you see that, and again, look at the behavior: impulsive, corrective, impulsive, corrective, impulsive, corrective. That stair step. All right. I think I have one more in this list. The EVH And this is more along the lines of that bowl-shaped kind of move that I like. Let's go to a one-year chart. You can see, actually, this is probably a little bit more of a V-shaped move, but you have this big decline down. And notice on the way down, you have impulsive, corrective, impulsive, corrective, impulsive. And then you get this little sharp move up, and then this is corrective. And you break this downtrend line. And then you get impulsive. This might be a little bit acting a little bit corrective, but it looks like you're kind of reversing trend, right? You're acting more like an uptrend right now. And the nice thing about these types of patterns is if this continues, you immediately have a target. At the very least, you would expect it to get back up to that previous high. Doesn't mean it will, but at least you can visually kind of see the potential there. Depending on, I could put a stop. Here's where we broke out. Maybe we do pull back. We came close to pulling back to that breakout area. Maybe we still do. Put a stop down below there. If I'm wrong, I lose this much. If I'm right, I potentially gain that much. 2-to-1 reward to risk or so. But I like those types of trades. Again, because it's acting like an uptrend, I can see potential reward to risk in my favor. These are the only things I can control. I can't control what it does next, but if I can find 10 trades like this that look like they're a reversing trend and acting like an uptrend, I'm going to make 2 times or 3 times what I lose if I'm wrong. Then it's just a numbers game. I don't know which ones are going to work and which ones won't, but most of the time, I should have 50% of the time they should work. And that means I'm bringing in more money when I'm right than I'm losing when I'm wrong. And that's trading. That's what trading is. It's not, let me overanalyze this thing because there's got to be a way I can know exactly what it's going to do next. No. It's just finding stocks that are acting the right way and then managing the risk, making sure that the reward potential is greater than the risk. All right, let's go into a couple of individual sectors here. Computer and technology. Near the top of the list here, this AEHR 99 strength rank. Now this one, again, hopefully the market pulls back a little bit. I'd like to see it come down a little bit further because it's still pretty far away from that breakout area. It doesn't have to come all the way back to it, but I'd like to see it come down. And one thing too is if this is wave A and this is wave B, wave C tends to be about the same length as wave A, so that one gets down around this area here. The stock is cleared in an uptrend, and it looks like it's consolidating. This looks correct. This looks impulsive. This looks corrective. This also gets back to what you hear me say all the time. Whenever you see a stock moving sideways, you want to pay attention to the direction it's moving in before it moves sideways. That's where it's more likely to go after it's done moving sideways. We'll see what happens there. Business services, under business services sector. This UCL 99 strength rank. And this looks like it could be in a little bit of an ABC correction, a little bit of a corrective type pattern, pulling back to the breakout area right there. Again, we're not looking for exactness in the breakout area because this still looks like it could pull back a little bit further. Notice the pause right here. Look in the near term at a drop, pause, drop. But if you're on a stock like this, these are all the ones on these individual or these sectors here. These are all under the hold section. So you're waiting for it to go from, you could wait for this to go back to a buy signal. If it starts moving up, it'll probably go back to a buy signal right in this area right here. That could be your confirmation. It continues to go down and it keeps going down. Well, it never gave you that confirmation. Never went back to a buy signal. Who cares if it keeps going down? All right. I did make a adjustment to the portfolio. Look at that. Obviously, my two gold stocks have dropped a little bit. But I had that wider stop on those. I was clear about that early on, that I wanted to stay in these things for a while. Take a look at the other trades. First Solar is getting back down to where my stop area is, down in this area right here. I'm going to have to look at that at the end of the day. Now, I usually like to close below my stop area if I'm going to stop out, so I'll look at these at the close. And with the way the market's acting, there's probably a pretty good chance I'll get stopped out of this, although I still like the pattern. That looks corrected. It looks like it should have another move up, but it might be one of those where I get stopped out, and then I might have to look to re-enter again if the market starts taking off again. And the purpose, I had tighter stops, and there's always a risk of a tighter stop is that you'll get stopped out more often. But remember when I got into these, if you've been around and you remember, I got into these, the market was starting to turn more bullish, but we still are in this area where there's still a possibility we could retest those October lows, and there could be, there is a possibility the market hasn't bottomed yet. So to combat that a little bit, I won't risk as much. I'll have a tighter stop. But again, the danger of that is you can get stopped out and then have it turn right back around again. That's happened a few times in the portfolio. This one's still looking good. FMC, again, we got close to stopping out on this day right there. Then it came back, and then it's gone up since then. So that one still looks okay. I don't think we're in danger on that one. SGML, same thing, got close. Now it's down a little bit today and could ultimately end up popping me out. GDX, another gold trade there. And then I added the SPXS. Remember, this is the inverse ETF of the S&P 500. This will go up if the S&P goes down. I use these just very temporarily. I use them a lot as hedges. I won't use them really at all, or very, very rarely when we're in a bull market condition, because when you're still in a bear market condition, stocks will fall a lot faster than they rise. And so when the market rallies within a downtrend, it tends to be more choppy, and then it drops sharply and rallies, tries to rally, and then you drop sharply. This is what I worry about when I start loading up on trades and still in the bear market, is you're always in danger of that big drop. I want to make sure, the worst thing I can do right now is lose a ton of money in this bear market. You're just trying to keep as much money as you can, so that when the market does bottom out, you got as much capital to put in the market as possible, so you can ride that whole bull market up. You don't want to spend the first half of the bull market making up for all your losses in the bear market. Okay, it's frustrating. So that's why we're not loaded up right now. But we have tighter stops. I don't want to get out of my positions, because I don't. If we are done and we're moving up, I got far more bullish trades that should take advantage of that. But I want to hedge a little bit. And with the market, I usually do this when the market looks like it's very short term, looks like it's going to pull back. Oh, by the way, the reason why I don't do it very much in bull markets is the opposite is taking place. You get these sharp moves up. Yeah, the market could look like it's going to pull back a little bit, but it's probably just a little shallow pullback, and then it's going to take off again. So there's no reason to feel like I've got to hedge a lot in those situations. Now, if it's real obvious that I'm going to get a pullback in a bull market over a couple of days, and I know how to hedge with these inverse ETFs, so I may do it. Just get in. It's like anytime you can see a high probability trade, it's hard not to not to take advantage of it, especially if it can hedge you a little bit on some of your longer positions. But I don't use these much in the bullish conditions that I do in the bearish conditions. But so let's look at the S&P chart, the SPY. What we talked about in our analysis earlier was that we're expecting this to pull back a little bit. And so the opposite of that is the inverse of that is that SPXS. And this is looking like it could go up a little bit if that market goes down. Now, I'm not looking to make a ton on this, just to offset a little bit. I might lose on getting stopped out of the other trades. My stop is down below here. If the market breaks, that means if it drops down here, the market is breaking out higher. It's probably on another run. And so what that's allowed me to do is, so, I've been stuck in this 137 to 139,000 area for a while. That's okay. I'm all right with that. Because again, my number one goal during a bear market is don't lose money. If I can make some trades that make me a little bit of money, and I've worked this up from like 120 or something like that, from 120 to 137. When we started the bear market, I think I was around 120. So again, it's not a big gain, but the biggest goal is I'm not losing anything. And I have lost some. I mean, we were up to 141 or something. It's come back down to 137. That's okay. I'm not expecting to only have gains. It'll fluctuate, but I don't want to be back down at 120 at the end of the bear market. When I've been able to squeak out some of these gains over the last year, I want to hold them as much as I can. So, I'm more likely to hedge in that type of situation with that SPXS. I also like to use the SOXS, but that's the chip sector inverse. And that is, and the chip stocks have been holding up pretty well. So this one I make a little bit more money on when it runs, but I didn't like that one as a hedge. The other one I like to use is the SARK, which is the opposite of the ARK Innovation Fund. And that one might have been one that would work a little bit here. That fund has been pulling back a little bit today. But I went ahead and just used the S&P one there. Now these are really only designed to be very short-term instruments. You don't want to be holding on to these for 3 or 4 months. I only will hold on to these for a few days at the most. They're a decaying asset, the way they're set up, but they work really well. They allow you to be long the market and when the markets are going down. So you don't have to short stocks. If you don't like shorting stocks, this is a way you can make money when the market goes down without having to short. And shorting is pretty risky. I don't like to short stocks. It's not the same as buying stocks. It's a lot more risk involved and a lot more discipline involved that you need to have. And so this is a way that you can still benefit from the market going down, but still be long. All right, that's all I have. I don't see any questions. So if you do have any questions that you think of, just make sure you email those to me. I'll be happy to answer those for you. Have a great week. We'll see you on Tuesday for the next market update class. Bye now.